Have you ever pondered what the price of Tesla's stock will be after the stock split in a year? Experts estimate that the price of Tesla shares at year's end will be quite low. Other analysts now differ on the amount of Tesla shares that will be available in the upcoming year. You'll want to see this through to the end. According to one analyst, Tesla's stock might reach $400 in the upcoming 12 months. The experts predict that 2023 will be a significant year for Tesla, particularly in light of the anticipated introduction of the Semi and Cybertruck, which many customers are eager to see. But according to Emmanuel Rosner of Deutsche Bank, the significant potential cost savings from two distinct sources might have a significant effect on gross margins. According to Rosner, we now project that Tesla might increase its gross margin by an additional 300 basis points BPS in the upcoming year as a result of a favorable mix shift toward lower COGS production sites and the receipt of IRS battery production credits in the United States. According to Rosner, Tesla could achieve an average cost savings of $2,400 per vehicle, or 6.5% by expanding its production footprint to lower COGS locations and facilities, specifically the new Berlin and Austin plants, which are less expensive to operate than the Fremont operation. Considering that it begins with a base cost of goods sold per car COGS of $36,000 in 2021, before the impact of rising raw material prices and inflationary expenses that result in higher product prices. Credits for American battery production located in Fremont and Texas may also help save an additional $800 per car. Together, the possible $3,200 cost savings per car might result in an improvement of 5.5% of the average selling price when averaged around the globe. While tempering expectations, Rosner cautiously projects 2023 gross margins to increase by 200 basis points from 29.5% to 31.5%. This implies a 3,300 basis point improvement from 2022 levels, translating into adjusted EPS increasing from 6.60 cents to 7.15, which is significantly higher than the average estimate of 5.82 cents. Nevertheless, Rosner maintained his buy recommendation for Tesla and increased his 12-month price objective from $375 to $400. Conversely, the street's average target price for the shares is still a relatively modest $311.97, indicating a roughly 8% upside from present levels. Based on a consensus analysis with 18 buys, 6 holds, and 5 sells, experts rank this stock as a moderate buy. However, a Deutsche Bank analyst clarifies that 2023 will be crucial for Tesla. Indeed, Wall Street bulls are still buying Tesla shares in large quantities, citing a variety of possible triggers. Mid-September saw Emmanuel Rosner, an analyst with Deutsche Bank, declare categorically that he thinks the Tesla stock boom is only getting started and that the business would likely have numerous catalysts in 2023. We view 2023 as a pivotal year in which Tesla continues to grow volume at a high pace, enters new segments with Cybertruck and Semi, optimizes its manufacturing footprint, and benefits from IRA Inflation Reduction Act, which will lower its cost and boost demand, Rosner stated. We see considerable room for upward revision to 2023 street estimates from these factors, with additional upside potential to gross margin from full self-driving, with every 5% improvement in global take rate on new sales boosting gross margin by another 80 basis points, which is not in our base case scenario. Almost the last few months, the stock of the electric vehicle manufacturer has increased by almost 40%, surpassing the NASDAQ Composite's 8% rise and exceeding competitors like as Ford and GM. Wall Street attributes the increase to hope for new laws that will encourage the use of electric vehicles starting in 2023 and beyond. Investor opinion toward Tesla has also increased as a result of the company's excellent performance in the first 2 quarters of this year. In August, the stock saw a modest decline due to a general market retreat. Rosner anticipates that reduced manufacturing costs will be a major source of future profit for Tesla. He continued, while the company's gross margin improvement has slowed down this year due to costs and inefficiencies from COVID-related lockdowns and ramping up new factories, we believe Tesla is still on track to grow this metric in 2022, the writer stated. More importantly, looking ahead to next year, we now forecast Tesla could lift gross margin by another 300 basis points year over year, thanks to positive mix shift towards lower cost of goods sold production facilities and benefit from IRS battery production credits in the U.S., according to Rosner. The corporation is mainly countering the impact of growing raw material and inflationary cost through increases in product prices, starting from a basic cost of goods sold per car of $36,000 in 2021. Expanding its manufacturing footprint to lower cost regions and facilities could, in our estimation, save $2,400 per vehicle or 6.5% on average in costs. Additionally, the U.S. battery production credits in Fremont and Texas could save an additional $800 per vehicle, average globally. He continued by saying that the $3,200 total cost savings per car might amount to a benefit of 5.5% of the average selling price. However, we only cautiously enhanced 2023 gross margins from 29.5% to 71.15%, which is a 300 basis point improvement over 2022 levels. Additionally, we raised adjusted EPS from $6.60 to $7.15, which is significantly more than the $5.82 consensus. Rosner said that the anticipated 2023 release of Tesla Cybertruck and semi-vehicles could increase demand in the long run as volume increases. We anticipate even greater potential for operating margin growth and more opportunities for improvement in gross margin, according to Rosner. We still think Tesla is one of the best stories in the auto industry because of its competitive pricing, excellent cost structure, excellent execution, secured supply, and now established more significant capacity to support significant expansion. Some forecast that the post-split Tesla shares will reach $500 by 2023. Beyond the enthusiasm around the actual stock split, they think there are other favorable catalysts as well. First, Musk hinted on Twitter that 2 new electric vehicle types would be delivered. Tesla 500-mile range semi-truck starts shipping this year, Cybertruck next year, the tweet read. Additionally, Tesla declared that it had shortened the 8-week delivery wait period for its Model Y in China to 4 weeks. This is encouraging since it shows that there is a high level of demand for the Model Y in China and that Tesla's supply chain problems might be abating. The finest part was probably when President Biden signed the Inflation Reduction Act, which offers a $7,500 tax credit on new electric vehicle purchases that meet certain requirements. This ought to hasten the U.S.'s adoption of EVs in general and Tesla vehicles in particular. In 2023, experts predict that Tesla will have delivered over 2 million cars. According to an analyst, shares could surge to $360 in the upcoming year. The analyst's optimism is mostly based on Tesla's increasing production capacity. Accordingly, the Wedbush analyst believes that yearly deliveries could increase dramatically the following year, from fewer than 1 million in 2021 to over 2 million in 2023. Although such extraordinary expansion might. Dan Ives estimate that Tesla will produce 2 million cars in 2022 may appear wildly optimistic, but it's actually rather conservative. Upon closer inspection, Ives raised Wedbush's 12-month price objective for Tesla stock in late August, citing the company's overall momentum going into the end of the year and improved production rates at its high-output factory in China from a split-adjusted $333 to $360. It is well known that when the government imposed restrictions on manufacturing operations early this year in an attempt to prevent the spread of COVID-19, Tesla's Shanghai facility experienced significant delays. However, the carmaker reported in its second quarter update that at the conclusion of the quarter, production rates at the significant plant had not only recovered but had reached all-time highs, with investors considering this momentum in conjunction with Tesla's reportedly ongoing progress at its California facility and its stepping up of production at additional plants in Berlin and Texas. 2 million deliveries in 2023 start to look attainable after all. The plants of Tesla are already set up to produce around 1.9 million units a year on an annualized basis. Furthermore, Tesla hasn't said that it plans to reduce its investments in raising its production capacity. Indeed, the corporation has stated that by year's end, it hopes to be using all of its present manufacturing capacity. Elon Musk, the CEO of Tesla, stated on the firm's second quarter results call that the company had a good chance of finishing this year at 40,000 vehicles per week. This corresponds to a yearly run rate above 2 million units. At the most recent annual shareholders meeting, Musk stated that the company eventually hopes to have built 10 to 12 factories, with the new one supporting massive output of roughly 1.5 to 2 million vehicles per year. However, the delivery of 2 million vehicles in the upcoming year would only represent a fraction of the company's vision. If you want more Tesla stock predictions, subscribe to this channel.